All right, welcome everyone. We are going to go ahead and get started now. This is Don Kaufman, and we are going to kick off our Options 201 Part 2 here. And we're just really going to kind of kick in right where we left off yesterday. So stay tuned. I'm going to give you a quick kind of recap of what we went through yesterday. But we left off right here is buying a call versus buying a call spread. And it's, again, some of the what we call option essentials in here. So as we do go along, again, we make sure we're tuned in, turned on here momentarily. So there we go. Again, kind of a quick recap, and this is I started and left off yesterday and started again on what I think is one of the more pivotal portions of understanding Options 201 when I say the essentials. So verticals and calendars, which is what this Options 201 class happens to be, it's essentials because these are the building blocks of every trade you're really going to do. You know, people don't necessarily recognize like a calendar spread, and we'll start talking about calendar spreads tomorrow, but the calendar spread, it's everything, whether you do covered calls, whether you do rolling a vertical spread, okay, whatever you really do in the marketplace, the calendar spread is essential because it's the rolling component of trading. The vertical spread, which is what we're covering here, and the second portion of that today, this vertical spread is so essential because it's the building block behind iron condors. Well, obviously vertical spreads, butterflies, iron butterflies, like you name it, it's part of the vertical spread. So the one thing that I will consistently state is that, you know, you don't need to take classes in like, you know, they always hear like there's 20 different strategies and you need to learn them all, you know. No, you don't. You don't need to learn all the strategies out there. You need to learn about verticals and calendars because those are the strategies. You know, the criteria doesn't really even differentiate that much, whether it's a butterfly, an iron condor. And I will do you know, many subsequent classes here at TheoTrade, which is all part of TheoTrade. Like, you know, what TheoTrade ultimately is, you know, you come to the chat room, great. You don't have to be in the chat room every day. Some people are going to watch this in an archive. Fantastic. You know, you can watch the coaching sessions. Great. But the classes, okay, they're just part of TheoTrade. And whether you're experienced or not, these building blocks, again, they are the essentials for all of the classes that we're kind of laying out, whether I'm doing a class or, you know, eventually Tony doing a class or, you know, Doc doing a class over here. All these building blocks are going to be essential to that. So yesterday we explained just a little bit about the basics of the vertical spread. You're buying one option, selling another option against it. But what I think is one of the more pivotal areas of the vertical spread is exactly this. You're actually looking at buying a 30 call versus buying a 30-35 call spread. And when it comes to percentage returns on your money, it's, you know, the reality kind of sets in, and very few people have ever really looked at, hey, let's look at, you know, an example where you do, in fact, compare and contrast a trade, which is, again, buying a call versus buying a call spread. And you'll see percentage returns of the call spread are not only better, but there's, you know, $2.50 of risk in buying the call when there's only $1 of risk in the call spread. So pretty much in every case you can think of, the call spread, what I call, takes the cake. And that's exactly the next slide over here. Spreads take the cake. In most cases, a spread needs substantially less movement in the stock price to become profitable than does buying, okay, put or call. Combine this with the fact that spreads reduce capital investment and limit risk. This is what makes it a bread and butter play of TheoTrade. All of you, you're Theo traders. So that's why I think it's so essential to kind of lay that out over there to cut through a lot of the garbage. And, you know, sometimes you get people, well, I know something and that's why I'm buying a call, or I know something and I'm buying a put. Recognize nobody knows anything. I think it's a good place to start in the market. So this is what I call our spreads ducks, our spreads ducks in a row. That's a tongue twister over there. Let's just clarify what's what. There's different types of spreads, and we've gone through only a couple of them right now, but we're going to start to bridge our way into this. But buying a vertical call spread is bullish, right? You want the market to obviously go up. Buying a vertical put spread is bearish. Selling a vertical call spread is bearish. Oh, selling a vertical put spread is bullish. So what's kind of crazy about spreads here, and yesterday we were doing the same example again and again and again and again, right? You're to the point where like, stop the insanity. What did we have yesterday? We had a stock, and the stock was trading roughly at 105, right? By the way, that stock at 105, what could that be? That could be Apple. So Apple happens to be trading right now in and around 105. That's fine. And we were turning around and we were buying a 105 call. The C will stand for call. And we were selling, okay, all right, the 110 call, and the entire trade, it can vary in price, but let's say the entire trade, if you were to buy this spread, it goes for one net debit. And let's say that that's about like $1.50. So the most you can lose in that trade is about $1.50. The most you can make, again, is the width of the spread, which is what? $5. So you can make $5, but you paid $1.50 debit out front. So what can you actually make on it? $3.50. Now, these three components are essential. What? The debit you paid for the spread, number one. Number two, the width of the strikes, right, which is $5. Number three, what you can actually make. Why are those three things essential? Because you're going to need them later to figure out probability. And probability is essential. But I like to get our, what I call the spreads ducks in a row, because we're going to look at all of these fast spreads. Now, whether you're experienced or not, things are about to get a little bit deeper. Opposites are the same. To me, one of the most essential things in understanding spreads. You know, a lot of times people come to me and they go, I'm doing me a bull call spread, a bear call spread, a bull put spread, a bear put spread. If you've ever heard those terms, okay, bull call spread, bear call spread, bull put spread, bear put spread, they actually come out of one of the original options books. And one of those original options books, it was written in the 1980s. It was Larry McMillan. It was Options as a Strategic Investment. Now, I've known Larry since literally I'm a kid. You know, I've known Larry. He knew people in my family going way back. I mean, the options world, if you were in options back in the 1980s, there was only a few thousand people in the entire industry back then. So it was small, tight-knit, and I had family that traded. So anyway, they knew Larry McMillan and known him. And ever since I'm like, you know, going out there and teaching a little bit about options, I always tell Larry, I'm like, why did you have to do that bull call spread, bear put spread, and, you know, bull put spread? It's actually confusing. We're either long a spread or we're short a spread. It has calls or it has puts. And I like to always reiterate that point. You're either long a spread or short a spread. It's got calls or it's got puts. And this is going to matter because you're going to learn right now that opposites, okay, no, they don't attract. They're the same. Opposites attract. I'm very attracted to put spreads right now. And somebody's got to ask me, well, are you attracted to long put spreads or short put spreads? Yes, I'm very attracted to long put spreads right now. All right, this is when trading just gets weird. Opposites are the same. The equivalent of buying a vertical call spread is selling a vertical put spread with the same strike prices. This one perplexes people in both cases. You want the stock to go up. Wait, go back a slide. Buying a vertical call spread is bullish. Selling a vertical put spread is bullish. So what we're doing here, I'm just reflecting back to another slide over here. What we're doing here is actually recognizing that these could actually be what? The same. These could be the same, which means what? A vertical put spread, all right, is bearish. Buying a put spread is bearish, but selling a call spread is also bearish. So these are the same. And that's actually why I'll put this slide together over here to see that opposites are actually the same. In buying the call spread, you want the stock to go up and make money. In selling the put spread, again, you want the stock to go up to keep the money you received. Now, let's continue on. Selling the equivalent vertical spread, bullish positions. Okay, so we're actually looking at this. There's actually a term for this, and very few people ever hear this term, but This is what they call the box spread. It's understanding the box. But if you can understand the box spread, you don't have to understand why it's called a box spread. But if you can understand the box, there is no stopping you. There's no stopping you in the marketplace if you can understand what I'm about to go through. Okay? This is as complex as options ever get. And I'm serious about that. The calendar spreads we'll do tomorrow and, the next day over there, they get a little bit wild, but this is as complex as options get. All right. So I'm going to lay this thing out for you right now. Hopefully, guys, get it. If you buy a 100-105 call spread for $1.50, that equals selling a 100-105 put spread at $3.50. What? Okay. Now, I'm going to actually mark up my screen over here a little bit because I want this to get through. There's two major things we're doing today. We're going to do the box and we're going to do probability. And probability is the coolest thing ever, but got to get through the box. The box is this. This is, and I'm going to lay it out for you. This is buying the 100 call, okay, and sell the 105 call. Now that trade is done, okay, for a debit of what? $1.50. It's actually the same, okay, as this. So wait, is this thing bullish or bearish? Is that bullish or bearish? Anybody? It's bullish, bearish. Okay. It says right here. It's a bullish position. You want the stock to go up. Now, what happens if I went out, okay, and I did the equivalent put spread? Now, I want you to think about this. This one's a little bit confusing. We're going to sell a 105 put. Okay, and we're going to buy the 100 put. Now, this particular spread happens to be done for a $3.50 credit. Time out for a second. This spread's done for a credit. It's a $5 wide spread. How much can you lose in a $5 wide spread? You can lose $5. But you collected a $3.50 credit up front. So what's your risk? $1.50. This one is $1.50 a risk, right? There's your put spread. So this side is our put spread. This side is our call spread. The call spread, what's the debit? The debit is what? $1.50. What can you lose? $1.50. See, all the time when people get involved in options, they are immediately told, sell options, sell options, sell options. And I always back away and I go, but isn't selling options the same thing as buying options? And they go, no, selling options is selling options. Buying options is buying options. I go, yes. But as it refers to a spread, aren't these the same? Let's say right now the stock happens to be trading, okay, and we're going to say stock is at 100. These spreads are actually identical, but people always get you to think that a credit is going to be better than debit. That's actually not true at all. Now, I might do the debit spread instead of the credit spread, but people think they're actually collecting the $3.50 up front. Let me tell you something. I spent 15 years at a brokerage firm. You ain't collecting no $3.50 up front. Okay? The $3.50 up front, that's not your money. So what? You sold it for a $3.50 credit. But I might be able to collect some $3.50. Yes, you might be able to collect $3.50 if the stock moves above 105. But you might be able to collect the same $3.50 if the stock moves above 105 in the debit spread. These are actually synthetically identical. Synthetically identical means, roughly speaking, like if you think of like, I don't know, a football, right? A football, they used to call it like it's a pig skin. Well, they haven't made it out of pig skin in a really long time, right? Throw the pig skin around. People have heard that. So what do? Okay. You create a synthetic football. What is it made out of? I don't want to know. But it's pretty much the same as the original pigskin footballs. Guys, see where I'm going with this? These are actually identical. And from a brokerage standpoint, they're the same because in a margin account, it ties up $5. In a margin account, this trade ties up $5. But the reduction in buying power is identical. See, people get infatuated with things called margin. Margin is actually like a little fictitious calculation that the Fed came up with, okay, all the way back in the 1970s. And yes, the Fed actually controls margin. And there's regulation T margin on these. But what's really important isn't the margin, it's the buying power reduction. And the buying power reduction is the actual risk. So if the trade has $1.50 at risk, that's the buying power reduction. If this trade has $1.50 at risk, it's what? That's the buying power reduction. That's it. So they're actually the exact same trades. Now, stock is your favorite symbol now. All right. To continue on over here. Bearish position, selling the equivalent vertical spread. Now this stuff, I'm making them, a little bit more intense as we go on because this stuff, it's difficult. And we're going to go into the live market here in a moment. We're actually going to look at a spread. So here, okay, we're bearish. We're bearish and we'll say stock, all right, happens to be, again, at 100. So let's look at this. We're buying, okay, this 195 put spread for $1.50 and selling a call spread of the exact same thing. And again, they're equivalents. They're equivalents because the risk here is $1.50, the risk is $1.50, the break-even points are the same, the max profit, it's all identical. Now, if I were to lay this one out, if you put the stock at 100 and you're turning around and you're buying a put spread, now buying a put spread is a bearish position. Buy, for instance, the 100 put. Now, if you just bought the put, where do you want the stock to go? Down. But then what are you doing? Okay, you're selling the 95 put against it, and the entire trade is done for $1.50 debit. Now, okay, you're like, okay, I get that. I think I get that. I think I can. I got it. All right. So the exact same thing is true over here. Here's the 95-100 call spread. Now, if you went out there, for example, and you sell a 100 call, where do you want the stock to go? Down. Well, the stock's actually trading at 100. You sell the 100 call, you want it to go down. You turn around, okay, for instance, and buy the 95 call. And again, what does this equal? All right, so you actually go out there and you're selling the spread, and it equals a 350 in this case credit, but it actually aligns, apologize, that's a 3. It actually aligns identically to the other spread. They're just the inverse. Okay? Call spreads and put spreads are interchangeable. Now, don't let this, okay? So he says, I get the synthetic stuff, but what's the box? Well, I'm going to show you as we move forward over here what the box happens to be. Okay? As you start to look at this, call and put spreads are interchangeable. Now, this is something that, again, if this is the first time that you've ever gone through this, it gets a little bit fuzzy. It does. It gets a little bit fuzzy. You got to go through it a couple of times. And I don't want you to think that, if you're not getting it the very first time that you see it, that you're, I have failed you. Okay, I have failed you. No, you got to look at it a couple times. But call spreads and put spreads are interchangeable. Buying the vertical put spread is the same as selling, the vertical call spread, but the same strike prices. In both cases, you want the stock to go down. Again, buying a put spread, when you buy a put spread, you want the stock to go down so you can make money. Selling the call spread, you want the stock to go down so you can keep the money received. Same thing. To do the equivalent, you do the same. Okay, whatever strike price option you buy and sell for one spread, you could do. You would buy exactly the same strike prices and sell exactly the same strike price to do the equivalent spread. All right, and again, they really become equivalent, and that's one of the things that I just want to stress. Now, time out for a second. It's kind of hard to see, like when you're like the 50-55 spread. Let's go into a live market. It's like one of the first times, I guess, we've done this during this Options 201. Now we're going to go into a live market, and I'm going to display exactly what we've been referencing. And I'm going to do it in Google because Google is just this big, huge, behemoth monstrosity of a stock. And what I want you to see is, let's say, first and foremost, that we are bullish on Google. So we're going to denote, let's say we're bullish on Google. It's neither here nor there, and I'm going to tighten up the number of strikes that you see here to not confuse the issue any further, because there's a lot of strikes in here, right? We're going to go out there being bullish on Google, and we're going to buy a spread. Now, here happens to be, and I'm going to make this a nice round number spread, okay? Instead of being the 735s, I'm going to make the 735s, okay, 740. It's a $5 wide spread. And that $5 wide spread is trading for about $2.60, okay? But this is, again, it's a real spread, okay? It's in a live market right now. What I want you to see is, with this particular spread, where do you want the market to go? Well, again, we're buying the 735s, all right? So there's our buy. We're selling the 740s. This is a spread that we're actually purchasing for about $2.60. So what's the most you can make on a spread? $5, of which you paid $2.60 up front. So what's the most you can possibly make? Well, if you pay $2.60 up front, it's a $5 wide spread. You can only make out of this thing $2.40. Now, last time I looked, that's not spectacular. It really is not very spectacular, but that's neither here nor there. What is important is that you could do, all right, an equivalent spread. Now, I'm buying the call spread. What could I do in the puts to be like the same type of spread? All right, what can I do in the puts to be bullish? Well, I could go out there, and I'm actually going to build the spread and show you equivalent spreads side by side over here. I can go out and I can do the opposing spread. Now, this is also going to be bullish. I could sell, all right, we're going to go sell vertical. We're going to sell the 740, for instance, 735 vertical. Now, you'll see slightly different prices because, granted, the markets are open right now. They're kind of going back and forth a little bit here. These are what we term equivalent spreads. Buying the spread, again, for $2.60 is the same as selling a spread for $2.35. And you're like, oh, this is just racking my brain. I'll make it even easier over here. Lock down the price right now. Work the math, okay? And I'm going to do it with you because this is in a live market. Can't make stuff up in the live market over here because these prices, right, are updating. So this is a $5 wide spread. If you pay $2.65, okay, $2.65 out of your pocket over there, well, what are you getting yourself involved in? Let's actually hit, the confirm and send over here. And you're going to see precisely the cost of the trade over there. Trade number 1, it's $2.65. Trade number 2, $2.35. So just to take everybody through some of the logic in this, okay, if it's a $5 wide spread, and again, I always reiterate, trying to pick nice round numbers here like a $5 wide spread, but if you have a $5 wide spread and you pay $2.65, okay, the most that you can possibly make on this first spread here, and again, I'm going to just write it up on the screen so everybody sees it. Again, it's a $5 wide spread of which you paid, what, $2.65. So the most you can actually make on there is $2.35. Now, here's a put spread. Now, what do we actually do on a particular put spread? Now, this one's a debit. We're buying the call spread and being bullish. The second trade over here happens to be none other than a credit. And we're selling it for what? The same $2.35. What can you lose on it then? $2.65. They're actually the same. By the way, yes, I changed this to blast all over here just to pull the trades up next to one another because I thought that would be a little bit easier, if you will, to be able to interpret. So as you look at the trades, again, I'm selling the 740, 735. People have a lot of tough time with the put spread. Now, again, these are basically the exact same trade. You are seeing it dollar for dollar. They're identical positions. Now, there's a lot of criteria that we will go through, okay, in future iterations and future courses here at TheoTrade that will teach you precisely which truly is the better spread. There is one of these that's better than the other. And I'm going to give you a hint here, and it'll shock you. Okay? In this particular trade, you'd actually rather buy the spread than sell the spread. And it has to do with exercise or assignment risks in there. But the spreads are pricing identically. One is equivalent to the other. Now, again, this begins what they call the box spread. What a box spread basically is pricing two trades against one another. Now, we're going to go into another underlying over here, and I like to pick these big behemoth stocks to go through. And here's another big behemoth stock, and Amazon. It's a $618 stock. But now let's do a bearish trade. And the bearish trade is maybe, I don't know, maybe you think Amazon's going to go down. Maybe you think Amazon's actually going to go down. So you buy like a 615, 610 spread. And here's a $5 wide spread. Okay, trading for about $2.30 some odd cents. It's bouncing around a little bit. Now, to do the equivalent, you do the what? The same. So if this happens to be what? A put spread that we're buying for $2.33, I might be able to do the equivalent, sell a call spread, but this call spread that I'd be selling would be considered in the money. In the money call spread. And all I have to do is select the right strikes here. Okay, so we're going to select the correct strikes. And again, you're going to see that these are perfectly inverted to one another. You're like, whoa, that's crazy. It is crazy. Think about this. Here's a $5 wide spread for $2.30 debit. $5 wide spread for $2.30 debit. What's the most you can make on it then? Well, it's a $5 wide spread. You pay $2.30 up front. You can make $2.70 on it. Here's the equivalent spread, trading for $2.70. If it's trading for $2.70, what's the most you can make? $2.70. What's the risk? $2.30. They're interchangeable. Calls and puts are a lockstep relationship. There is no difference. And that's one of the things I try to reiterate time and time again. Now, we'll leave it at that because, again, there's so much. If you just looked at the equivalents over time, this stuff is just huge just to understand that put-call relationship over there. And again, don't worry about which options to buy or sell yet. And that's another point I want to reiterate here is that at this point in the game, here we are at options 201. We're just trying to get you comfortable with structure of the trades. Okay, structure of the trade simply means like don't worry right now about which options should I trade. That is criteria. Okay, so in every trade that we do, and we're going to look through all these different trades, right? Every trade